Well, 2017 was a very tough year for the energy stocks. And it was the first time in 20 years that energy stocks declined at a time when the broader markets were increasing and the price of oil was going up. Although 2017 was a tough year, we look forward to 2018 as an improving market for the energy stocks, particularly as investors begin to appreciate three things about the energy market. The first is that the recovery in oil prices that we saw beginning in the second half of last year when we reached a two-year high is sustainable. Second, that the oil demand will continue to grow as the global economies continue to grow. And third, that the supply restraint that has been shown by OPEC and its partners is in fact going to be continuing. So when those three things become more apparent to the market, we think it's going to be good for the energy stocks. There are three segments of the energy sector that we particularly see value in at this point. The first is in the exploration and production companies, the E&P companies. The second is in refiners, and the third is in liquefied natural gas companies, LNG companies. With respect to E&P companies, 2017 was a very rough year, but we see that they are poised to benefit from rising oil prices because they are the companies that are the most sensitive to the oil price. In terms of the E&P companies that we like those companies that have attractive properties in the Permian Basin in West Texas, because the Permian Basin is the most productive region in the U.S. for oil production. We also, as I said, we like refiners because although they were the best performing sector in the energy sector, the segment of the energy sector last year, they are going to benefit from the rising exports of U.S. petroleum products and petroleum. With respect to LNG stocks, we like them because there is definitely growing demand globally for LNG products. So we see opportunities in that sector. But it's important to keep in mind what investing in the energy sector provides. It provides two things. It provides diversification versus the broader equity markets, and it provides inflation protection. The diversification comes from the fact that energy companies the correlation between energy company stocks and the broader markets is very low, meaning that it moves in opposition to the way the broader market is moving. So the broader market is going up, energy stocks typically do not go up at the same rate. But when broader markets are falling, energy stocks are going to act in opposition of the low correlation, which gives you diversification for your portfolio. But with respect to inflation protection, there is a very interesting study that has been recently published by GMO, which is a well-respected research firm. And they looked at the 8 periods of time going back to 1933 when U.S. inflation was 5% or greater for a year or longer. And in 6 of those 8 periods, they found that a basket of energy stocks and material stocks kept up with or beat inflation over that period of time. And that in all 8 of those periods, that basket of energy stocks and material stocks outperformed the S&P 500. So you want to keep in mind your diversification and your inflation protection from the energy sector.